On January 9th, 2026, the smart money saw the first domino fall. A single social media post from Donald Trump reignited his plan for a 10% interest rate cap on credit cards. For Wall Street, it was a kill signal. Within hours, giants like JPMorgan and Citi hemorrhaged billions in market value as their stocks plunged. This wasn't just a sell-off. It was the beginning of a $1.1 trillion reset of the entire American credit system. For millions of Americans drowning in debt, the promise of a 10% cap sounds like a miracle. But for the big banks, it's a death sentence. And while the old guard of finance braces for impact, one fintech company is uniquely positioned to build an empire from the ruins. But to understand the future of the U.S. economy under this cap, we first have to look at what I call the Kenya warning, a real-world economic experiment that provides a terrifying roadmap for what happens when governments try to force interest rates down. This is how one political promise could shatter the credit card industry, and what our SoFi Stock Analysis 2026 predicts for investors who see what's coming. To understand the sheer force of this proposal, you have to see the machine is designed to break. The American credit card industry is a behemoth, built on the interest it charges on over $1.1 trillion in consumer debt. These aren't just abstract figures. They represent immense financial pressure on households using credit cards just to get by. The average APR is a staggering 21%, but for millions, it's closer to 30%. That massive gap is where big banks have built their empire. Enter the Trump Credit Card Interest Cap 2026, a one-year 10% limit that could redirect over $100 billion a year from bank profits back into consumers' pockets. While it's just a proposal, it's pouring fuel on existing legislative debates like the bipartisan S-381 Sanders-Hawley bill. But what if a company didn't need to charge 21% to win? What if it was already built to thrive near that 10% number? That is the SoFi secret, and it's hiding in the 8.74% starting APR on their personal loans. In a moment, we'll reveal how that one number is designed to profit from this exact chaos. So what happens if this 10% cap becomes law? For major banks, it's an extinction-level event for their credit card divisions. Banks like Capital One and Citi have a model built on pricing risk. A customer with a 650 FICO score is riskier, so they get a higher rate, often near 28%, to cover potential defaults. A 10% cap destroys this model. The banks are left with two choices: lend to that person and lose a fortune, or stop lending to them entirely. The choice is obvious. Bank of America's CEO has already warned that rate caps will destroy credit availability for the masses. Wall Street analysts agree, with experts stating a 10% cap would make nearly half of the entire consumer credit market unprofitable for them. This isn't financial relief. For anyone with a credit score below the mid-700s, it's a financial cutoff. Let's do some quick, brutal math to see why bank executives are panicking. The lifeblood of a credit card portfolio is its interest revenue. Forget profit for a second, just the raw cash coming in the door. The average APR on cards that carry a balance is around 25%. A 10% cap forces that number down by 15 percentage points. What does that mean in simple terms? That 15-point drop represents a staggering 60% of their expected interest revenue. Gone. Vanished. It's like a restaurant owner being told they have to cut the price of their main course by 60%, but still pay for all the ingredients. It's a mathematical sledgehammer to the top line. For every $1 billion in interest they were projected to earn from these customers, $600 million is wiped out before they even pay a single employee or account for a single default. This revenue cliff is the first step toward total unprofitability, which brings us to the deeper math. Let's do the technical profit margin math the banks are doing right now. It's called net interest margin, or NIM, and it's the lifeblood of their business. Imagine a bank lends out $100 on a credit card at a 21% APR. That's $21 in potential revenue. First, they have their cost of funds, the interest they pay on deposits. Let's call that 3%. So that's $3 off the top. Then come operational costs, fraud departments, marketing, servicing the account. That's another 4%, or $4. Now the bank is at $14 in profit. But here's the killer: risk, or what they call charge-offs. For riskier borrowers, banks expect to lose around 8 to 10% to defaults. Let's be generous and say it's 8%, or $8. So $21 in revenue, minus $3 for funds, minus $4 for operations, minus $8 for risk, leaves them with $6 of profit. A healthy, if not high, margin. Now apply the Trump 10% cap. The revenue is just $10. Subtract the same $3 for funds and $4 for operations. You're at $3. Now subtract the $8 for risk. You are now at negative $5. For every $100 they lend to this customer, they are projected to lose $5. That entire portfolio is not just unprofitable, it's what Wall Street calls uninvestable. This is why they won't just lower rates. The math makes it impossible. To see this credit famine in action, we don't need a crystal ball. We need to look at what happened in Kenya in 2016. In an attempt to make credit more affordable, the government enacted a law capping lending rates at 4% above their central bank rate. The goal was noble and sounds identical to today's proposal: help everyday people and small businesses get access to cheaper capital. The result was an immediate and catastrophic economic disaster. Instead of lowering rates for riskier borrowers, banks simply cut them off entirely. Why? Because they could no longer price for risk. A small business loan is inherently riskier than buying a safe government bond. When the law forced the potential profit on both to be similar, banks chose the safer option every time, reallocating their money to large, safe corporations and government debt. A post-mortem study by the World Bank found a significant decline in total private sector lending. Critically, there was a massive shift in capital away from the very people the law was meant to help. Credit to small and medium-sized enterprises, which provide up to 80% of jobs in Kenya, collapsed. Analysts reported that SMEs were denied loans worth nearly $3 billion during the period the cap was in effect. The financial oxygen for entrepreneurs and small businesses was completely cut off. What was intended as a rescue mission became, in the words of the IMF, a collapse of credit for the most vulnerable. After 3 years of economic damage and rising unemployment, Kenya was forced to repeal the law in 2019. The lesson for the U.S. is brutally clear. Rate caps don't lower rates for the masses, they eliminate access entirely. But wait, it gets worse, and this time it hits your wallet directly. Those airline miles, that cash back, the travel points you're saving up, a 10% cap makes them mathematically extinct. Here's why. Credit card rewards are funded by two main sources. The first is the interchange fee, the small 1.5% to 3% cut a merchant pays every time you swipe your card. But that's not nearly enough to pay for your first-class ticket to Japan. The real money comes from the high net interest margin we just discussed. The massive profits banks make from the 21 to 30% interest paid by customers who carry a balance effectively creates a giant subsidy pool. Banks use a slice of that pool as a marketing expense to fund lavish rewards programs for all customers, especially the big spending ones who pay their balance every month. When a 10% cap vaporizes that profit pool, the subsidy is gone. The interchange fees alone can't support the system. Banks aren't charities. They will not pay for your vacation out of their own pocket. The entire rewards ecosystem implodes. Perks gone overnight. If you're finding value in this analysis, hit that like button. It tells YouTube you want more content like this and helps the channel grow. Now let's get back to the chaos. The political landscape is wild. While Trump champions this, many in his own party are horrified. Progressives are skeptical, noting Trump had 4 years to address rip-off rates and did nothing. But the legislative model for this cap, the bipartisan S-381 bill, gives us another clue. Buried inside it is a critical detail, a sunset clause. This clause means the 10% cap would automatically expire after a set period, in this case, 5 years, unless Congress actively votes to extend it. This isn't a permanent rewriting of finance. It's a temporary, high-stakes experiment. For banks, this is even worse. Why would they re-engineer their entire business model for a law that might vanish in 60 months? They won't. They'll simply shut down lending to anyone deemed risky for 5 years and wait for the clock to run out. For the average consumer, this is a chilling thought. Imagine your credit card, your safety net, suddenly canceled. Where do you turn? This void creates the exact opportunity SoFi is built to fill. To see the investment opportunity, let's compare the three sides of this new battlefield: the dying giants, the niche players, and the heir apparent from a field of potential fintech stock winners. In the first corner, you have the old guard, companies like Synchrony Financial and Capital One. Their entire business model is built on offering credit cards, often to customers with sub-700 credit scores. To make this profitable, they must charge high interest rates to compensate for higher default risk. A 10% cap isn't just a problem for these companies. Analysts warn it is a direct nuclear strike on their core business model, rendering it completely unprofitable. Their only rational response is to massively pull back on lending, cutting off millions of customers. In the second corner are the buy now, pay later providers. These companies might see a short-term benefit as some consumers who are cut off from traditional credit look for alternatives. However, their model is mostly for smaller, point-of-sale purchases and often relies on being interest-free for a short time. They aren't equipped to handle the massive existing debt that Americans hold. They are a temporary patch, not a solution to a trillion-dollar problem. Finally, let's look at SoFi. A 10% cap does hurt their own small credit card business, but that's a flesh wound. SoFi's primary weapon and main profit driver is the personal loan. Their core business is literally built to solve the exact problem this new law creates: refinancing high-interest credit card debt into a single, lower-rate installment loan. In a world where millions suddenly have their credit cards canceled or credit lines slashed, a product designed to consolidate and pay off those balances becomes an essential lifeline. So while the business model for Synchrony breaks and BNPL players scramble for scraps, SoFi's model is perfectly designed to capture the fallout. The very event that cripples traditional lenders becomes the single greatest customer acquisition event in SoFi's history. It's not a fair fight. The storm that sinks one ship provides the wind for the other's sails. The vacuum left by the big banks creates a once-in-a-generation opportunity. And among potential fintech winners, no one is better positioned than SoFi. SoFi began by refinancing student loans. Now it's a digital bank offering checking, savings, and most importantly, personal loans. The SoFi personal loan strategy is converting high-interest credit card debt into a single loan with a lower fixed rate. In a world where millions of credit cards are being canceled, a product designed to pay off those balances becomes the most valuable financial tool on the market. SoFi's CEO Anthony Noto is actively rooting for this policy, believing it will create a large void in credit access and accelerate the shift toward his company. This is a CEO openly cheering for a policy that could cripple his competitors. Wall Street analysts agree. A note from Mizuho Securities predicts a surge of consumers flocking to fintech lenders like SoFi, unlocking tremendous growth. The market's reaction tells the same story. As bank stocks plunged, the outlook for our SoFi Stock Analysis 2026 caused its shares to surge. Investors recognize that for every customer abandoned by Chase, SoFi stands to gain a customer for life. This is how SoFi becomes a beast, through a tidal wave of new personal loan customers, its primary profit driver. While SoFi's small credit card business would take a hit, the net effect would be a boom. So, is this proposal a fatal flaw in the system or a financial revolution? It forces a tough choice between lower interest rates and the entire reward system that runs on them. I want to know where you stand. Here's the question. Would you trade your 2% cash back for a 10% interest cap? Let me know in the comments below.